Right now, company executives are quietly writing checks worth tens of millions of dollars into their own stock, and most everyday investors have no idea it's happening. We're not talking about a junior manager grabbing a few shares for show. We're talking chief executives, chief financial officers, and major shareholders putting real personal money on the line while the broader market feels shaky. One name on today's list has seen insider buying cross the $100 million mark. But a massive insider purchase does not automatically mean a stock is about to take off. Sometimes an executive buys because they believe the market overreacted. Sometimes it's a long-term conviction play, and sometimes insiders pile into businesses that are still genuinely risky and unproven. If you like digging past the headlines to find what's actually worth your attention, stick around. Because by the end, you'll have a full ranked list, from the riskiest insider buy on the board to the one setup that brings together the strongest mix of conviction, business quality, and upside. And if breakdowns like this help you make sense of what's really happening in the market, hit that subscribe button right now on Tickerhawk, because we publish videos just like this multiple times a week, and you won't want to miss the next one. Before we get into individual names, let's talk about the bigger picture, because context matters here more than usual. The major indexes this month have told two very different stories depending on where you look. Certain chip and artificial intelligence names are still running hot, while a lot of established technology giants have taken a real beating. That kind of split is exactly the environment where insider buying becomes worth watching, because it's a selective market, where some stocks keep climbing and others quietly get left behind. What makes this moment stranger is the emotional disconnect. Prices have kept grinding higher for months, yet consumer confidence surveys keep showing ordinary Americans feel uneasy about their financial future. When prices and sentiment pull in opposite directions, picking the right individual stock matters far more than just buying an index and hoping for the best. A huge part of why this market feels lopsided comes down to semiconductors. That sector has had an enormous run, and when one corner of the market moves this aggressively, money tends to crowd in there and starve other good businesses of attention. The biggest companies on the planet have also become almost absurdly dominant, with the top 20 stocks now roughly 60 times the size of the average company outside that group, and retail options trading sites near record levels, telling me plenty of traders are still chasing whatever's hot instead of asking what's actually a good deal. There's also a near-term risk worth flagging. Some major banks estimate that quarter-end portfolio rebalancing alone could trigger well over $100 billion in selling pressure across stocks. And we've already seen a preview of what hype without fundamentals looks like in some of this year's hottest public offerings, where early buyers were underwater within days. Hype and actual value are two very different things. One well-known value investor put it well recently, basically saying that while everyone's chasing the flashiest rocket ship stocks and chip plays, some of the most reliable, well-run businesses in the world have quietly gone on sale because investors got distracted by something shinier. That's the theme running through everything we're covering today. So here's how today's list works. I'm not hunting for any random insider purchase. I want buying that's meaningful in size, a stock that's genuinely pulled back, and a valuation that still makes sense. That combination separates a real signal from noise, and it's the filter we're running every name through today. Starting at number 7, the one I'd personally treat with the most caution despite the size of the buying, we have Summit Therapeutics, ticker SMMT. This is hands down the loudest insider buying story on this list, which is why I'm starting here. Two co-founders separately bought close to $50 million worth of stock each, an absolutely massive show of conviction, and additional executives, including the chief operating officer and chief financial officer, added shares worth several $100,000 each. From a headline perspective, nothing else on today's list comes close to this level of insider conviction. But here's where caution kicks in. The stock is down more than 20% this year, sitting at a valuation north of $10 billion, and forward earnings per share are still firmly negative. This isn't a steady, profitable business with reliable cash flow, so a traditional discounted cash flow valuation doesn't apply cleanly. This is a speculative biotech story, not a value investing case study. Wall Street does see enormous potential upside, with average price targets implying gains north of 100%, but that kind of projected reward usually comes bundled with serious risk. It's interesting, but with profitability still deeply negative, it earns the number 7 spot, because the insider conviction is paired with genuine uncertainty. Moving to number 6, we land on Lululemon, ticker Lulu, a completely different animal. This isn't an unproven biotech. It's an established apparel brand with a long, profitable track record, yet the stock has been hammered this year. Insiders have stepped in too, with a company director and the company president each adding roughly $500,000 worth of shares, bringing combined insider buying to around $1 million. The stock is down close to 46% year to date. a brutal decline for a brand that used to trade like a premium growth darling. The obvious question is whether insiders are buying because the sell-off went too far, or whether the stock is cheap because the business is genuinely losing steam. On valuation, the stock looks inexpensive, trading around 10 times forward earnings versus a 5-year average closer to 30, roughly a 65% discount to its historical norm. The problem is growth. Revenue projections have weakened, forward operating income estimates have turned negative, and earnings expectations tell a similarly soft story. The balance sheet remains solid, so this isn't financial distress, but the slowdown is real enough that it's tough to call this a screaming buy yet. Wall Street sees modest upside near 19%, and my own discounted cash flow model lands close to a 10% margin of safety on fairly conservative assumptions. For now, this is a name to watch for signs of stabilization rather than something to back the truck up on today. At number 5 sits Broadcom, ticker AVGO, arguably one of the best-run businesses on this list, but also one of the least cheap. A company director recently added 1,000 shares worth just under $400,000, meaningful even though small relative to Broadcom's size. The stock is up 19% this year, with a valuation around $2 trillion, far from beaten down. The growth profile is outstanding, with projected revenue growth approaching 50% and earnings expected to compound north of 40% annually. Broadcom has also become a phenomenal dividend growth story, with 15 straight years of annual increases. The catch is valuation. The dividend yield sits well below its own 5-year average, and the stock trades above most historical fair value estimates I track. Wall Street projects roughly 27% upside, while my own discounted cash flow model lands closer to an 8% margin of safety. Broadcom remains a fantastic business, and the insider purchase is a positive signal, but the price tag doesn't leave much room for error, which keeps it out of my top tier today. Number 4 belongs to Mercado Libre, ticker MELI, one of the highest quality growth companies in the world right now. Unlike Broadcom, this stock has been weak, down close to 19% year to date and sitting near 52-week lows. 2 recent insider purchases caught my attention, with a chief accountant adding around $200,000 and a director adding closer to $1 million, combining to roughly $1.2 million. Despite the price weakness, business quality remains exceptional, with forward revenue growth projected around 35%, and long-term earnings expected to compound above 30% annually. Wall Street stays strongly bullish, with price targets implying upside above 30%. The valuation looks stretched on the surface, trading around 40 times forward earnings, but factoring in the growth rate, the stock actually trades at a discount to the broader sector. My own discounted cash flow model suggests roughly a 9% margin of safety. Mercado Libre has earned plenty of benefit of the doubt through years of consistent delivery, but the bar for continued performance stays high, which is why, elite as this business is, it doesn't quite crack my top 3 today. Climbing to number 3, we have SoFi Technologies, ticker SoFi, a name that's polarizing, volatile, and constantly debated. What stands out isn't a single large purchase, but a pattern of repeated buying from the chief executive across several months, including multiple purchases worth around $250,000 each in recent weeks, plus additional buying. Stretching back earlier in the year, repeated executive buying over an extended period tends to carry more weight than a single isolated purchase. The stock is down roughly 32% this year, with short interest elevated near 15%, making this a genuine battleground stock where bulls see a disruptive fintech reshaping consumer banking and bears worry about valuation and execution risk. The growth numbers are impressive, with forward revenue growth projected near 30% and earnings per share expected to grow around 27%. Wall Street price targets imply upside in the high teens, though forecasts range widely between bearish and bullish scenarios. On valuation, the stock trades at a steep premium to traditional banks, but factoring growth into the equation, that premium looks more reasonable. The balance sheet trend has also improved meaningfully, which matters for a financial company. My discounted cash flow model suggests a fairly wide margin of safety, though Wall Street's own targets are more conservative. SoFi remains higher risk than most names here, but the combination of repeated executive buying and strong growth earns it a spot firmly in the top half. At number 2, we land on NASDAQ Incorporated, ticker NDAQ, not the flashiest name in this video, but from a pure risk-reward standpoint, possibly the cleanest setup we've covered. A major shareholder purchased shares worth nearly $5 million, a substantial commitment for a business of this size and maturity. The stock is down 15% this year and trading toward the lower end of its 52-week range, with forward earnings multiples sitting around 20 to 21 times. Reasonable for a quality financial infrastructure business, rather than a deep bargain. The growth profile is solid without being explosive, with forward revenue growth projected just above 10%, slightly ahead of the sector average, and earnings growth expected near 16%, also outpacing sector norms. Wall Street sees roughly 30% upside, and on valuation, the dividend yield sits above its historical average, while the forward earnings multiple cites below it, both signs the stock isn't expensive relative to its own track record. This is also a strong dividend growth story, with 13 consecutive years of annual increases, and the balance sheet remains manageable with leverage trending favorably. My discounted cash flow model points to roughly a 25% margin of safety, broadly in line with Wall Street's own bullish expectations. This combination of meaningful insider buying, reasonable pricing, consistent dividend growth, and manageable debt makes NASDAQ one of the more compelling setups on today's list. And that brings us to number 1, the name that stands out above everything else covered today, Autodesk, ticker ADSK. This is the combination I look for every time: meaningful insider buying, a real valuation reset, strong free cash flow, and genuine upside potential all lining up together. The insider activity here is notable not just in size, but in who's doing the buying. The chief executive purchased shares worth roughly $500,000. The chief financial officer added a similar amount, and a company director contributed close to $800,000, bringing total recent insider buying to nearly $1.8 million. When the people actually running daily operations step up to buy after a steep decline, that signal carries extra weight compared to a single outside director making a modest purchase. The stock is down 35% this year, and forward earnings multiples have compressed to around 15 times, which stands out immediately for a software company generating this much free cash flow. Wall Street has responded with a strongly bullish stance, projecting upside above 60%. On valuation, the stock trades at roughly a 50% discount to its own 5-year average earnings multiple, and even factoring in growth, it still looks meaningfully cheaper than the broader software sector. Growth isn't explosive, with forward revenue projected around 14%, slightly ahead of both the sector and the company's own historical average. But Autodesk doesn't need hypergrowth to work at this price. The balance sheet is essentially pristine, with debt levels close to zero, giving management plenty of flexibility in an uncertain environment. My discounted cash flow model lands right around $300 per share, implying a margin of safety north of 30%, matching Wall Street's own bullish targets. Perhaps most telling, a reverse calculation shows the market is currently pricing in almost no growth at all going forward, which tells you just how beaten down sentiment has become. When expectations are this low and the people running the company are personally buying shares, that's exactly the kind of setup that gets my attention. Autodesk isn't flawless, growth has cooled, and sentiment remains shaky. But among everything we covered today, it brings together the strongest overall mix of conviction, valuation, balance sheet, strength, and upside potential. So here's the full lineup one more time, from most cautious to most compelling. Number 7, Summit Therapeutics. Enormous insider buying, but still deeply speculative with no positive free cash flow to lean on. Number 6, Lululemon. Genuinely cheap on paper, but facing real questions about slowing growth. Number 5, Broadcom, an outstanding business that doesn't leave much margin for error at today's price. Number 4, Mercado Libre, an elite compounder that still isn't what most would call obviously cheap. Number 3, SoFi, repeated executive buying and strong growth, balanced against real volatility and execution risk. Number 2, NASDAQ, a clean combination of quality, reasonable valuation, and reliable dividend growth. And number 1, Autodesk, the setup that brings everything together most convincingly today. If you had to pick just 3 names to dig deeper into this week, I'd point you toward Autodesk for the cleanest valuation reset, NASDAQ for the steadiest quality and dividend growth combination, and SoFi if you're comfortable taking on more risk for higher potential reward. Summit Therapeutics and Lululemon are the 2 I'd approach with the most caution. One carries genuine speculative risk, and the other is still working through a real growth slowdown. Broadcom and Mercado Libre remain excellent companies in their own right. I just don't think the current price leaves enough cushion to make them top picks today. The real takeaway here isn't that insider buying guarantees a winning trade, because it doesn't. What it tells you is where company leadership is putting their own personal conviction on the line. And when that buying lines up with a real pullback in price and a valuation that still makes sense, that's worth paying close attention to. If you found this breakdown useful, drop a comment letting me know which of these 7 names you'd consider adding to your own portfolio. And if you haven't already, make sure you're subscribed here on Tickerhawk so you don't miss the next deep dive. Give this video a like if it helped you think about the market a little differently today, and share it with anyone who's been wondering where the real opportunities might be hiding right now. Thanks for watching, and I'll see you in the next one.